Welcome to the Deep Dive. Today, we're aiming to sort of cut through the jargon and give you a really clear picture of the financial health of a key player in India's energy transition. We're digging into the Indian Renewable Energy Development Agency, or IREDA. It's a big government of India enterprise, an infrastructure finance company focusing squarely on renewables. And specifically, we're looking at their audited financials for the first half of fiscal year 26. That's the 6-month ending September 30th, 2025. What really jumped out at me from the source material was just how fast they approved these results. The board meeting was October 14th, started at 8:45 a.m., done by 10:08 a.m. That's incredibly quick for such complex financials, right?
Oh, absolutely. That kind of speed, it definitely tells you something about their internal prep work. So what we're basing this on is, yeah, those official H1 results, both standalone and consolidated, but also the statutory auditor's report. That's critical. And interestingly, there are also some special purpose financial statements from September 2024, which they prepared for a planned qualified institutions placement, a QIP, gives us a bit more context.
Okay, got it. So why is this important for you, our listener?
Well, look, IREDA's financial strength is directly linked to how fast India can roll out renewable energy projects. Simple as that. And as an NBFC, IFC, they're navigating this pretty complex regulatory world. You've got SEBI's low DR rules for disclosure, ICDR for raising capital.
Like that QIP you mentioned.
Exactly. And then, crucially, the Reserve Bank of India is watching their lending, their risk management, everything. So we're not just looking at profit numbers. We're seeing how they handle all these rules.
That's a great point. They're juggling court orders, government goals, RBI rules, all at the same time. Okay, let's dive into the headline numbers then. H1 FY26 versus the same time last year, H1 FY25. How did things look?
The top line shows really, really strong growth, definitely expanding their reach. If you look at the consolidated numbers, total income from operations, it hit 4,017.69 crores.
Wow, over 4,000 crores. And how does that compare to last year?
That's a big jump from 3,141.08 crores in H1 FY25. So yeah, clear sign that demand for their financing is high and they're getting funds out the door.
Okay, impressive income growth. But I noticed the profit, the consolidated net profit after tax. It grew, but maybe not quite as dramatically. It went from about 771 crore to 796 crore.
Yeah, that's a really sharp observation. And it's the kind of thing you'd want to ask. You see this big jump in income, but the bottom line, the PAT, is more contained.
So what's putting the brakes on the profit growth then?
It often points towards prudent risk management. And that's exactly what the documents suggest here. They've significantly increased their impairment allowances, basically, setting aside more money for potential loan losses. We'll get into the details on that.
Oh, okay.
So they're booking the income, yes, but they're also being quite conservative, using that expected credit loss, or ECL, approach to provision for potential risks ahead. It holds back the current profit number a bit, but it makes the balance sheet stronger long term.
Right. Prioritizing safety over just maximizing this quarter's profit number.
Yeah.
That makes sense. And this stability, this should show up in the balance sheet size too. How are those metrics looking?
Yeah, the balance sheet definitely shows a growing institution, and importantly, with more capital depth. Consolidated net worth is way up, 12,922.15 crores as of September 30th, 2025.
And compared to the year before?
The year ago, it was 9,336.13 crores. So that's a substantial increase. Could be strong profits being retained, maybe new capital coming in. Either way, it boosts their ability to lend more.
The loans themselves, their core business.
That's grown significantly too. Total loan assets are now at 84,396.08 crores. That's up from about 64,462 crores a year prior. So roughly a 20 billion rupee increase in loans outstanding.
Which is exactly what you'd expect, right? Given their mandate to push the energy transition.
Precisely. They're clearly doing the job financing those big projects.
Now, before we move off the basics, there was something interesting in the consolidation notes. A new subsidiary, IREDA Global Green Energy Finance IFSC Limited, in Gift City.
Yes, that's right. Incorporated back in February 2025 and included in the consolidated results from Q4 FY25 onwards.
What's the thinking behind setting up shop in an IFSC like Gift City?
That's a really key strategic move, actually. While their main business is still financing projects in India, having this entity in Gift City, well, it signals they want easier access to international money.
Ah, okay. Foreign capital.
Exactly. IFSCs offer tax benefits, smoother regulations, all designed to attract foreign investment. For a huge infrastructure lender like IREDA, it's a smart way to diversify their funding. Think global green bonds, maybe syndicated loans from international banks, potentially avoiding some of the friction with foreign currency flows you might see domestically. It's setting the stage for future global fundraising.
That definitely adds another layer. So they're not just thinking domestically anymore. Okay, with that huge loan growth, let's shift gears to maybe the trickiest part, asset quality. Specifically, this issue around NPAs, non-performing assets.
Right, and this is where you see that tension between following legal orders and maintaining really strict financial reporting. The auditor's report flagged this with what's called an emphasis of matter.
Which basically means, hey, investor, pay attention to this bit.
Exactly. It doesn't mean the accounts are wrong, but it highlights something unusual or particularly important.
And the issue is about certain loan accounts, totaling 407.20 crores. The auditors note these should technically be classified as Stage 3, or NPA, under the usual RBI rules, but they're not. They're listed as Stage 2 or Standard.
Correct. And the reason given is straightforward. IREDA received interim orders from honorable high courts regarding these specific accounts.
So a court order is preventing the NPA classification.
Essentially, yes. When a court issues a stay or specific instructions on how to classify an account, the lender, even a government entity like IREDA, has to follow that order.
Yeah.
Legally, they can't just slap the NPA label on it right now. It protects those specific borrowers, at least temporarily.
Okay, legally they're covered. But how do they stop the financial statements from looking healthier than they maybe are, given that underlying risk in those 407 crores? This is where that prudence comes in.
Precisely. This is where financial integrity takes precedence over just the bare legal minimum. Even though the court order dictates the classification, IREDA internally handles these accounts very cautiously. Critically, they only recognize interest income from these specific court-protected accounts when the cash actually comes in, on a collection basis.
Right. No booking income you haven't actually received. Basic good practice for doubtful debts.
Exactly. And crucially, they didn't just stop there. They also did make an allowance for impairment loss on these accounts anyway.
So even though it's Stage 2 on paper, they're still provisioning for potential losses.
Yes, using their expected credit loss model. They're assessing the likely future risk of default, regardless of what the current legal tag says. They're looking at the economic reality.
Can you quickly remind us what that ECL model involves? It's different from the old way, right?
Yeah, it is. The expected credit loss methodology forces companies to look ahead. Instead of waiting for a loan to actually go bad, the old incurred loss idea, they have to estimate the expected losses over the entire life of the loan, right from the start based on probabilities.
So provisions are made much earlier, even for loans that seem okay today, but might face trouble later.
That's the core idea. It's meant to be more forward-looking, recognize potential stress sooner. So IREDA is applying this forward-looking view even to those legally protected accounts.
Okay, so this commitment to provisioning, despite the classification issue, should be visible in their overall numbers for allowances.
It absolutely is. If you look at the cumulative impairment allowance, that's the total ECL provision across all loan stages, plus non-fund stuff like guarantees, it stands at 2,348.90 crores as of September 30th, 2025.
And how does that compare?
It's a hefty increase from 1,687.58 crores just a year earlier. This really confirms that proactive provisioning strategy we talked about, and it helps explain why the PD growth was somewhat contained despite rising income. They're building up their safety buffer.
Got it. And what about the loans that are officially classified as Stage 3, the actual NPAs?
Those total 3,352.92 crores as of the reporting date.
And the coverage for those? How much have they provisioned against those specifically?
For those concerned Stage 3 assets, they have a provisioning coverage ratio of 51.48%.
Okay, 51.48%. Is that considered decent for this kind of lender?
Yeah, that's quite solid for an MBFC IFC. Holding provisions equal to over half the value of your recognized bad loans provides a pretty substantial cushion against potential losses if those assets need to be written off. It shows a strong focus on managing credit risk.
Which logically leads us to the next big question.
Yeah.
How are they actually funding all this growth and managing their overall debt load? Being an infrastructure lender, they must be constantly tapping the debt markets. Any recent fundraising activity mentioned in this quarter's report?
They were indeed active. During the quarter ending September 30th, 2025, IREDA raised 453 crores. This was done through a private placement of non-convertible securities.
Okay, what kind of securities?
Specifically, it was the IREDA Perpetual Taxable Unsecured Bonds Series POI2.
And crucially, Did they use the money as intended? That's always a key governance check.
Yes, the disclosure is very clear on that. The report explicitly states the proceeds were fully utilized, primarily for on-lending, funding more renewable energy projects, and also for general corporate purposes.
And no diversions from the plan.
Correct. It specifically mentions no material deviation from the objectives stated when they issued the bonds. That points to good internal controls and efficient deployment of capital.
Okay, so that's one specific issuance. Let's zoom out. What's the bigger picture on their debt? Given that huge loan book, what does their total borrowing look like and how leveraged are they?
Right, the total picture. As of September 30th, 2025, their total financial indebtedness, which includes all their bonds, bank borrowings, subordinated debt, everything, stood at 69,939.38 crores, almost 70,000 crores.
That sounds like a massive number. How does it stack up against their equity? What's the debt-to-equity ratio?
The consolidated debt-to-equity ratio came in at 5.41 times.
5.41. For an NBFC, IFC focused on long gestation infrastructure projects, is that a comfortable level?
It's generally seen as manageable in this sector, and importantly, it's actually a slight improvement from the 5.85 times recorded a year earlier. So they're growing assets, but managing leverage reasonably well.
Does the RBI set limits or keep a close eye on this?
Oh, absolutely. The RBI monitors leverage ratios very closely for systemically important NBFCs like IREDA. A ratio like 5.41 suggests they still have some room to borrow more, especially with government backing, but it also means they need to stay really focused on managing their capital efficiently as the loan book keeps climbing. It's heading towards that 1 lakh core mark.
Right. And maybe the single most important question for anyone holding their debt or thinking about investing, did they pay their bills? Was the status on debt servicing?
Good news on that front. The report is totally clean. IREDA confirmed no default as of September 30th, 2025. No defaults on repaying any debt securities, no defaults on bank borrowings. All payments were made on time.
That's definitely reassuring. And for their secured debt, do they offer good collateral?
Yes, they do. For their secured non-convertible debt securities, the documents state they maintain a security cover of 2.61 times.
Meaning the assets pledged are worth more than 2.5 times the debt amount.
Exactly. In this case, the security is a charge on the company's receivables, the loan payments coming in. So bondholders have a very strong claim on assets worth significantly more than the debt itself. That's key for keeping borrowing costs down and maintaining market confidence.
And just to reiterate, their focus remains squarely on India's RE and energy efficiency sectors, right? No other major business lines muddying the waters.
Correct. It's all about financing green energy projects within India. No other reportable segments. Their entire financial structure is geared towards that specific mandate.
Okay, I think that gives us a really solid grasp of IREDA's performance and financial position in the first half of FY26. So just to quickly wrap up the key things for you, the listener, to take away. 3 main points, really. First, IREDA is clearly a major engine for growth. Big increases in income, huge expansion in their loan book. They are undeniably central to India's green energy goals. Second, they're managing that tricky situation with asset classification, the conflict between court orders and standard rules by being financially prudent, using collection basis accounting for some income, and importantly, proactively provisioning using that forward-looking ECL method. And third, their finances look pretty stable overall. They're raising money successfully, using it efficiently, keeping leverage manageable, and critically have a perfect record on paying their debts. No defaults.
Absolutely. And that point about provisioning and managing project risk ties into something else mentioned in the sources, something looking ahead. It's about future regulation.
Okay, what's that?
Well, remember, IREDA is an NBFC IFC regulated by the RBI. The sources mention these pending draft directions from the RBI. They're called income recognition, asset classification, and provisioning pertaining to advances projects under Implementation Directions 2024. Bit of a mouthful, often shortened to IRCPUI.
IRCPPUI. And what are these draft rules about?
They're basically aimed at creating standard rules for how banks and NBFCs handle loans for big, complex projects that are still being built. You know, the kind of large infrastructure projects that are IREDA's bread and butter, especially dealing with delays during construction.
Which must happen all the time with big energy projects.
Exactly. So if these draft rules get finalized, the IRACP2I could potentially tighten or at least standardize the rules around classifying these project loans, maybe forcing earlier recognition of stress if projects get delayed significantly.
So it could directly impact how IREDA calculates its provisions in the future.
It certainly could. Given that IREDA's entire business is financing these massive, sometimes complex, sometimes politically sensitive renewable energy projects, the final version of these updated, harmonized rules raises a really interesting question for the future.
Which is?
How will this standardization of project loan risk treatment ultimately change things? Will it refine the impairment calculations, making them maybe more accurate? Or could it potentially complicate things further for the NBFCs like IREDA that are absolutely vital for funding India's infrastructure ambitions? It's definitely a regulatory development worth keeping a close eye on.